be here and actually participate. Okay, we're going to kick off. I see one or two more people. See Atemba's joining. How's it, see Atemba? Cool. So we're going to kick off and get started. If the other guys join in, they will have access to the recording later. So that should be fun. What we're going to do is Business 101. So I want to go through a whole bunch of items that you guys may or may not have understood that you need to see in terms of your business. And often we get lost in the actual detail. So this will just be a way for you guys to step back a little bit and just look at what you may have done or lost or missed out on, or what you need to think about actually going forward. Okay, cool. You guys know who I am, so you don't need any additional information on that. Okay. So this is where we started. So, why do businesses implode? That's a very important thing to look at in terms of running your company. And funny enough, the thing that makes a business fall over faster more than anything else is not having your actual foundations in place properly, not having your paperwork drawn up nicely, not having your agreements in place, not being registered with the right authorities, not having your costings done, so you're always underpricing. So these are the things that we want to go through and avoid your actual business falling apart. Okay. Cool. So building a business is the same as building a house. You want to get your foundations right. You want to make sure that all the regulatory items are taken care of. You want to ensure that people have got access to your business, you've got access to suppliers, and you're able to essentially get your business running with the minimum amount of fuss possible. And by that, I don't mean the minimum amount of fuss in terms of you do the least possible. The idea would be to get all your sort of ducks in a row, dot your I's, cross your T's, so that the day-to-day running is simple. That's what you want to be after. So you do a lot of hard grunt work at the beginning, and then thereafter it's just maintenance. You're maintaining the actual status quo, and that gives you the opportunity. So you must have all heard the saying, working on your business instead of in your business. So initially when you're founding and starting up, you're working in your business, getting the structure right, getting all the paperwork right, getting the costing right. And then when that's all going and it's ticking over beautifully, you're then working on your business. And that then is transferring your gaze to what the future holds, what vertical integration you can possibly do on your business, what additional products you can add, what are the opportunities outside your province or your city or your country that you can look at. And those are things that you're working on your business. So that's where we want to go with this. Right, so the starting point is generally the business entities. So look, there are more than the 4 that are on here, but generally these are the 4 most common types. We begin with a sole prop. That's not a business you register, it's yourself. Your ID number is the number of the company, essentially, if you want to view it as an entity like a company. It's the simplest thing. There's no forms needed. You literally start trading. You generate an invoice, and you can call it whatever you want. So it'll be yourself, Tyron, trading as, tax, and off I go. And I can invoice people. I can have my expenses. Very simple. Then you've got your personal liability companies. That'll mostly be accountants, lawyers, a bit more legal structure, shareholding agreements. Closed corporations, we keep it on the list. So even though you can't register any new closed corporations, the closed corporations that are in existence remain in existence. Currently, there's no sunset clause. So if you have a closed corporation, you can continue trading on it as you ordinarily will. funny enough, the caveat is that it's actually more expensive for a small business to do their final annual financial statements for a closed corporation than it is to do it for a private company, because you still need an accounting officer to sign off your closed corporation, whereas a company can just have a competent person signing off. So there's no audit requirement or stuff like that, depending on your sort of scoring. And then, of course, the most popular that we have now, you go into SIPC, you register a business, 95% are PTY Ltd, private companies. That's the sort of de facto company that everyone operates on. That's generally what most of the clients trade under. You can get state-owned companies. You can obviously get limited companies. These are the ones that obviously list on the JSE. They can issue shares and stuff like that. So, but yeah, these are essentially the first four. These are the main four that we deal in the startup space that people are operating in. I don't know if you guys have any questions at the moment. Anyone's got a question with regards to what we've covered in terms of the entities?
Yes, it's Andile here. No,
Yes,
yes. On these entities, which one do you personally recommend that one should register a business under?
it's really around personal circumstance. So, and it's really around personal circumstance at the beginning. If you want to keep the costs down, being a sole proprietor, so maybe you have a full-time job, you want to start doing baking bread at night and selling it to your neighbors in the morning, you can run that on the side as a sole proprietor, things like that. And you can run many different entities. So definitely personal choice. When you get partners, then definitely go the route of a private company, because then it limits your actual liabilities and stuff like that. But very much a personal choice. But graduated up according to your risk profile. So if you're just running around on your own, getting started, it's a one-man band, sole and proprietor works very well. The taxation is similar to your personal taxes. It's on a sliding scale, so it just can keep the cost down. So that's where. Anyone else?
Okay, so just a follow-up question.
Go for it.
Okay. In terms of when one is looking for funding, for grant funding, do they consider the type of entity when they actually profiling you as a business before they actually assist you with funds? And
Yes.
if yes, which one does have the most points among the four?
Well, currently, if you're going to go for funding, they will look at you rather to be a private company, so they're contracting with a legal entity. So you generally register PTY Ltd, the private company, so that the funder can either take equity, so take shares in the enterprise, or if they're doing a loan, the loan will go to the business and legal entity, and then you yourself as the shareholder and director will sign personal surety on those loans. So most funding in South Africa, especially startup space, you're looking at private companies. Later on, people move into, obviously, if you're on the JSE or you want to offer your shares available over, available for trade in the public space, you'll be a limited company. But for the bulk, if a funder is going to give you money, you're going to go to the DTR or one of those guys. They're going to want to see a private company. If you already have a CC, that's perfectly fine. They won't make you change your CC into a company unless they want to take equity. Then it makes sense that you convert your CC into a company, because then they can limit their actual liability in terms of their risk. Does that help?
Yes, thank you very much for the clarity.
Perfect. Anyone else? Anything else around the entity that you would like to use to run your company or your enterprise?
Tyron,
Yep.
I think I maybe want to ask something. You and I have gone through this earlier in the year. Sorry, is there someone else that actually wanted to ask something?
Nope, it looks like it's you.
No, it's fine.
I think there was someone else. Okay, let me quickly finish, and then someone else can also ask. In terms of taxable items that you can claim, will you cover that later in the session, or is it something we can discuss now?
Yeah, well, I'll cover it in more detail. Suffice to say just one thing, that how the tax laws work is that you can claim any expense in the production of income. So you got to keep that sentence in your head all the time. So does this thing, whatever it is I'm spending the money on, help me produce my income? If you can draw a line between those two items, no matter how tenuous it might be, yes, keep the expense, claim it, because you can defend how it helps you earn your income. Does that help?
That's a great sentence. Yeah, that's a great sentence.
Perfect. But we'll dig into it a little bit deeper when we cover the tax a little bit later on. Perfect. Anyone else at the moment?
Yes, it's September here.
September, how's it, man?
I'm good, man. How are you?
Very well, man.
I have two questions. One will be, as a private company, we normally are scared of a taxman because a lot of people are touched by that. To my surprise, all the time go to the company, or they always tell me that we don't owe them to since we've been open of anything. They don't send us a letter to say we owe them or we have to visit them. My question is, how safe are we as a company of taxmen and vet? Because what they said to us is we are not allowed to charge clients a vet while we don't charge you as a company vet. I need a little bit of help there in terms of understanding the laws of.
Perfect. It's actually moving into our next slide, which is I'll cover those as we go through them. But on tax, something to remember is you only pay tax if you make a profit. So I like to view it as tax as a penalty on success. So the successful entrepreneurs get penalized by having to pay tax. So that's how I like to view it. Okay, so I'll cover those now to get to that point so you guys can see. So now you've chosen your entity and you think, what do I do next? So generally our procedure would be is if you've got more than one partner, you want to do a shareholders agreement. What you often find is that when you register your company with a subsidiary, you guys probably haven't even looked at this in more detail, but the MOR governs the legality around running the company. And what you find there is your 15.1 ABCD on your registration. That's your MOR when you register with SIPC. It governs what your distribution of dividends are. It discovers what the shareholders and directors can do. Do yourself a favor, if you've got a business registered, dig out your registration documents and look at your MOR. it's going to be a very handy thing to actually understand. Okay. Trademarks, very often people don't think about registering a trademark. You want to go through those if you've got a nice business name that you want to keep. So always look at it if you've got a nice particular brand that you're using or stuff like that. Something that a lot of companies end up doing, registering a trademark. It does take a while with CRPC, about 3 years. But at least once your application form's in, you can put the little TM, marker at the end of your brand to let people know that there's a trademark actually pending on this brand. And then patents, obviously, if you've got a really cool piece of tech or chemical formula that you're utilizing, or anything that is and unique to yourself, you can go and obviously patent this prior to, or once your business is actually registered, so that it's the intellectual property of the actual company now. Just a word of warning on patents, though. There's an industry really that's built around what they call patent sharks. And these are people that pretty much sit around the patent offices, because once the documents are lodged, they're public documents. And they then see what is being lodged, and they can obviously maybe get these products to market sooner. A lot of these things have happened if you look at, people find a patent, they'll see a nice cool product that's under the patent is going to be built, and before they've realized it's already been manufactured in China. So this does happen. So just bear that in mind with patents. A lot of people have started to leave certain elements out of their patent listing so that someone can't just copy the patent and then it just goes forward from there. So much easier to operate from. So these are the nice things to think about once you've started your company. Okay, now in terms of registration. When you register your business at CRPC, irrespective of whether it's you can't do CCs, but any of the enterprises there, the non-profit corporation, a normal liability company, P2I Ltd, that information is automatically transferred to SARS, and SARS registers you for income tax. So this was always the case, right back when CIPC was still called CIPRO, and they'll transfer the knowledge. So that at least now the receiver of revenue has got a tax number for every entity that's been registered. And this will come to the tax question that was asked. So even if your business does not trade, you registered a company at CIPC and you haven't got it off the ground, it's running, end of August, like now, next week, Monday, you'll have to submit your RP6, your tax to show that you, and even if it's zero, end of the tax year, February, you're going to have to submit another RP6. And then obviously you still have to submit your tax returns, even if you make no profit. Your business is dormant, you've got to submit this to SARS. So that's the way of keeping track of. That's why that registration is automatic. It does cause a few headaches of its own. If we've seen conversions from CCs to companies, they've given entities second tax numbers, which have caused great headache for us in the accounting industry. So that's a non-negotiable. The minute your business gets registered, you get an income tax number. Same as yourself, when you're working for an employer, they submit your RP5, you get a tax number from SARS. Even if you don't have to pay tax, you need a tax number. The next thing is UIF. The minute you employ somebody and they're working for more than 21 hours a month, you have to register for UIF. This is not pay as you earn. That's just the person might not be above the threshold for pay as you earn, but UIF is mandatory, as well as workman's comp. So your workman's compensation and UIF work hand in hand, because the minute you employ somebody, you've got to register for workman's compensation. It's a legal and requirement. A lot of people, for some reason, back in the day, only thought workman's comp applied to the actual construction sector, and a lot of companies were not registered with workman's compensation. So those are and we've listed this sort of in the sequence of it happening generally for a company in startup and then going forward into growth. So minute you employ somebody, UIF, workman's compensation, they both fall under the Department of Labor. If you don't know, so UIF is obviously unemployment insurance. You would have seen now with COVID, there were these TERS payouts and stuff like that. And that's what UIF is effectively there for. It's to help people then tide themselves over between finding a new job when they find themselves unemployed. Workman's compensation is like an insurance. So if you get injured on the job, slip down the stairs, break a leg, your employer can take you to any hospital, even fancy private hospital, and the hospital claims your treatment via the workman's compensation. So very, very important to have. And workman's compensation covers your employees from the time they leave home. So if they using a taxi, driving their private car, whether it's public or private transport, from the time they leave home to get to work, not talking about a joyride, visit your friends in between, but a direct trip from home to work and from work back home are covered as part of the workman's compensation. So, yeah. So as your staff start earning more, the next thing that kicks in is pay as you earn. That's often registered at SARS. And people often think, well, I registered for pay as you earn at SARS and now I've got a UIF number because I'm paying my unemployment to SARS. But you're not really paying. SARS is just going to take the payment from you and keep it in an escrow account. And then when you file your unemployment form, your UI-19, it then transfers the money over to UIF. So that's where a lot of people get mixed up in the terms that they register for pay as you earn and then they submit their EMP 201 forms. They then see they've got to submit the UIF as well. So they never register for UIF with the Department of Labor. So all that UIF they're paying over is just sitting in a bank account at SARS, an escrow, until they're registered with the Department of Labor for UIF, and then the money transfers across to UIF. STL, skills and development levy, that will you register for the minute, generally it's on your pay-as-you-earn form, but you only start paying it over when your payroll exceeds 500,000 Rand a year. So it's good to just keep a track of it. So if your total payroll for the year is less than 500,000 Rand, you're not going to be paying STL. And then it goes forward from there. VAT, just to come on to that, you can register as a voluntary registration for VAT. So providing your costs you're incurring are more than 70,000 at the moment, you can register as voluntary. Or otherwise it's mandatory when within the forthcoming year, you see your your turnover is going to exceed 1 million Rand in turnover. And then you should register. So if you can see, according to your invoicing, that you're going to exceed 1 million within that tax year, you need to register for VAT. Very important. You cannot charge customers VAT unless you're registered for VAT. Very, very crucial. So you can't go and charge someone unless you've registered. Excuse me. So a lot of people are confused about VAT and they think, oh, but if my business is small, what's the benefit? Think of VAT as not your money, because it's not. You just levying its value add. So when you're adding value to the service, you're buying the wood from the hardware, you making a table, you selling the table, that value that you're adding to the wood is then you're charging VAT on that. You can claim the VAT for the wood that you bought to offset so you're only ever paying over the actual difference in VAT. So the difference between what you've sold the product for and the difference between the expenses incurred in order to make that product. Rental, cell phone, the cost of sales that you're incurring and stuff like that. So yeah, you can't, if you're in a business that cannot, like you a dairy farmer or you're an egg farmer, you can't, it's one of those items that don't have VAT, they're VAT exempt. You can then not claim VAT on those items. So it's just important. It's quite technical around that, but the basic line is you must turn over R1 million a year before you register, and obviously you pay over the difference between what you are selling your products for and the expenses you're incurring that carry VAT. Okay, I don't know if anyone's got any good questions on those. Guys, anyone?
Yes. But yeah,
Hello?
just to get it right, you said I cannot register for VAT unless I make a R1 million turnover a year.
You can register for VAT if it's a voluntary registration. So if your expenses you're incurring are in excess of 70,000, but then your projection must be that within a period of time you're going to be exceeding the R1 million sales. So you can't, SARS is going to not let you register for VAT if you're only ever going to turn over 300 or 400,000, because they're going to go, well, there's no point. You just, there's the idea of that is when your turnover exceeds R1 million, it's becomes viable to be VAT registered, because a lot of times when you're that small, you're not incurring. You can obviously if you show that you're planning to get that route, but you can do a voluntary registration. But you really got to look at your circumstances and see if it's in your best interest to do so. So a lot of times we have clients who are exporting, which will come into play here for the artisans depot. You're exporting zero VAT. It's not nil VAT, it's zero VAT. So you can claim the VAT on the products you purchase in South Africa, but then you're not charging VAT to the clients outside the country, and therefore you're getting refunds. So those type of things is based on circumstance. So don't rush ahead to register. A lot of times there's a lot of confusion where we want to get onto a vendor list for a large corporate, and the vendor list says, what is your VAT number? You need a VAT number. You don't need a VAT number to be on the vendor list. So yeah, we've dealt with that quite a lot with corporates when we've been helping them with, the smaller guys joining the actual vendor list. That there's no requirement to be VAT registered if your turnover is less than R1 million. Does that help?
Yes, loud and clear. Thank you very much for the explanation. Thank you.
Great. Okay, guys, so now we've chosen our entity. We've seen some other registrations we should think about. Now these are the actual statutory stuff that, depending on the life cycle of your business where you are, you have to be registered for these items. Other regulations that we come across are the annual return we pay SIP-C every year. So every year on your anniversary, you've got to pay SIP-C annual and return. Often people confuse it with the SARS tax and return, but it's definitely to SIP-C only, and you can log on to your account and actually do it. BE certification is another regulation that a lot of our small businesses have to abide by. Generally, it's only legislated that listed companies and government organizations by law have to do BE. For everyone else, it's voluntary. But how they make the rest of our smaller companies volunteer to do it is that the large companies get points for higher certified BE and suppliers. So that's where it kicks in then for the smaller firms. We then all do BE certification in order to ensure we get the work, and that then obviously drives the uptake of the regulation. Tax clearance and certificate. This was brought in, I'm thinking probably about 7 years ago. It hasn't always been the case. government realized that there was a lot of fraud taking place and people were not paying their taxes, but yet they were doing work for the government. So they brought in the tax clearance certification to stop the fraud, and then also just to say to other companies, how can I pay you from the taxpayers' money when you yourself are not paying your taxes? That's really where it kicks into. They wanted to stop people getting paid with tax money if they themselves were not paying tax. It's kind of grown a little bit in terms of some of the large corporates decided they're not going to pay their suppliers unless they could produce a tax clearance and certificate. MTN was quite bad at this at the beginning. They didn't want to pay a lot of people because of it. The only person who can withhold your money if you don't have a tax clearance certification is the government. Nobody else. Not any corporate. They might want you to give a tax clearance when you sign up on their vendor list to prove that you're an honorable citizen, but they cannot withhold your payment if you don't have one. So just keep that in mind. A lot of us don't know this at the start, so it's very, very important to know. Public Access to Information Act manual. This has been put off for the last few years now, about 10 years now. What it does is the public can have access to your information. That's what the Act allows. If someone wants to come and find out about your business, who your shareholders are, they could come to your door, apply, and you've got to then allow them to see certain public information about your enterprise. It's been used a lot in the news. You'd find that political parties have used it against the government in order to extract information about certain transactions, about things that they feel didn't go according to plan. So the Public Access to Information Act allows them to do this. So it's legitimate for larger corporations. Governments kept putting it on hold and pushing out further for the smaller corporates, smaller companies like ours. So every year they push it out for a few more years and stuff like that. So it is something that might come into play for some of you as you grow. But at the moment, it's just something that it is there. Employment Equity Act is the same thing. Because of the injustice of the past, we have employment equity, where government wants to make sure that we have representation of all the citizens in our country at companies. The Employment Equity Act kicks in. Again, smaller companies are exempt from it in terms of, because it's often a one-man operation or a two-man operation. So you can't have equitable distribution of the citizens in the country. So it doesn't make sense. But it is still there, and once your business grows, you will need to submit your employment equity report, generally for the sort of medium firms every second year, and the larger companies obviously every single year. Annual financial statements are, of course, the final one. Every year you've got to prepare these, and you've got to submit them to the receiver of revenue when you file your income taxes. So those are the regulatory items that apply to every single entity that does business in SA. There are a bunch of others. If you have a liquor license, if you're a pub or stuff, you need a liquor license. If you're selling food, you need health violations or health codes and stuff. So these are just the basic stuff that everyone has to comply. There's a lot more. So questions. So now that you guys have heard of all these regulations and stuff, how many forms do you think us as small businesses have to submit for our business annually? Any ideas? Maybe you guys want to pop some answers into the chat box and see if any of you guys are even close. Anyone? Any guesses? Hey guys. No one wants to take a chance to guess.
I'll take a chance.
What do you think?
How many different documents does the average business need to submit?
On average, how many forms, different regulatory forms, do you as a small business have to submit annually?
Sure. I don't know. I'll go for 5.
Cool.
Can I take a guess? Oh, okay.
Go for it. It's a bit more than
6.
5. Cool. Let me give you guys an idea.
33.
These are the forms on basic forms. So for income tax, you do 3 forms a year. Your RP6s that are due in August and Feb, and then your RT14, where you're going to do your personal tax and return. Your UIF, your UI19, 12 of those go in, one every single month. Compensation, Commissioner, one goes in every year around about April. Pay as you earn, which includes your EMP 201s and then your EMP 501s, there's 14. So there's one pay as you earn form every month, and then an EMP 501 recon, where you recon those forms twice a year. STL is covered with your pay as you earn, and then VAT, if you're on a dual month cycle, that's 6 forms a year, but some of the larger companies are putting in VAT every single month. This is just the basic. If you have a liquor license, if you have any other health item, you need a business license. So it can be up to as many as 80 forms a year that have to go in and be signed, completed. And the government wonders why we as micro enterprises and small enterprises complain about red tape. Just to complete these forms, when you cost it out in time for an entrepreneur, an entrepreneur's spending probably about 16 hours a month working for the government to complete these forms. It's a lot of stuff. So when your accountant says to you, yeah, I can do your books, it's going to cost you like $600. I guarantee it's going to be bookkeeping only, debits and credits. And all these other items are not going to be looked at properly and submitted and things like that. So just spare a thought for those poor accountants, because they're going to have to submit these. And if they're not doing this, you're going to be the one who's going to be found out to not have all your information in place. It's like a heck of a lot of red tape involved. Cool. So that's just setting up your company. That's just the regulatory part. You haven't even done anything yet. You've thought about a business, you like the idea of starting a business, you've maybe knocked together a little business plan, and now you're going and you've done all of those things. You haven't even started yet. Okay. So yes, is where the fun stuff starts. What we're going to look at the accounting element, running your actual company now. You've got all the regulatory things in place, and now you want to get going. So the most important thing is accurate books. Guys, you cannot overemphasize to make sure your books are done accurately. And it doesn't have to be some very fancy, high-paid person doing this information for you. A lot of small businesses can do it on Excel, but as long as you're recording, your actual books. So obviously you look to the future. You create a little business plan, what you're estimating your income to be, what you're estimating your expenses to be. Cash is king, and by that we mean not just physical cash, because that means you got the money in your hand, no one owes you, they're not a debtor who's going to pay you later. But cash flow is effectively king as well, because the quicker you can turn your product into cash or turn it around, the better it is for you as a business. If you look at companies like ShopRite, Pick and Pay, Dis-Chem, things like that, we look at them as like a retail company, but those guys are really just banks. That products, because they've got payment terms, give you an idea, like Pick and Pay, that product has turned on their shelf 42 times before they pay the client for the first time it landed in their store. So you come along and you supply ShopRite or Spar, you're going to supply them 42 more times for that item before you get paid on the first one. So if you don't have deep pockets or a big overdraft or something like that, you're going to come short very fast. So these are the things to think about in terms of your business. Have I thought of as cash flow king? Do I have the cash flow? Do I have cash? Revenue completeness. So are you tracking all your income? Are you tracking all your expenses? It's very, very crucial. Often we don't think of it, in terms of our expenses. We don't realize that suddenly we got to hire somebody to do, a website, which we weren't expecting for. And then, we did account for a website, but now we need a pay gate. And now that costs us a bit more money. So these type of things then all tie in from there. So just look at the revenue completeness of the business, and we can go from there. Find an accounting system that actually works for you. There's a lot of free stuff available. Excel works. Look at it. Look at what's available. The investment of sitting with an accountant to set up your books, even if they're not doing your monthly books going forward, to spend an hour or two with an actual accountant who understands SMEs to set up your books for you is worth the money spent. You're never going to go wrong. It's going to give you a much clearer picture of your books as well. And then, of course, the last thing, a good financial foundation is staying out of trouble with SARS. And what a lot of people don't realize, the regulations are in such a way that a lot of people feel, I haven't got the money to pay my pay-as-you-earn, so I don't submit the form. SARS with the I was having a senior moment. The Tax Administration Act separated civil and criminal liability. So not submitting the form is a criminal offence. Not paying the money is a civil offence. So effectively, if you submit your VAT return form and you don't have the money to pay, yes, SARS gives you a penalty, which we know, and then they come after you like any other creditor out there. And you'll come to terms with them and you'll pay them and stuff like that. Not submitting the form itself is the criminal offence part, because now they don't know what you owe them. You might owe them nothing, but they don't know that. And the only way they can get to know that is they can physically come and fetch you, hence the criminal part, fetch you, put you in a room, and charge you criminally to submit those forms. So once you submit those forms, the criminal element falls away, and now you got the civil element. But they can still put you in jail for when it turns out to be fraud and those type of things. But I'm just talking where your intention is not fraud, it's just lack of knowledge, and you're not submitting the docs because you think, oh crap, I haven't got the money. Submit the forms. Even if you owe them the money, you'll get the penalty and you'll pay it down. So that's where keeping the stuff in line. Okay, next thing to look at. So once you settle these things up and you understand your business, budgets. Guys, budgets are the be-all and end-all of understanding your business. And it's important. And your budget will vary. It doesn't have to be, infinitesimally detailed. As long as you have an accurate picture of, you've tested your market, you know what you can sell the product for, you know what it costs you to make, and you know what the operating expenses are to get that product to market. So you want to separate the elements out. Obviously, there's sales, there's cost of sales. That's actually the cost of making the item, whether it's a computer program that you're building, whether it's a table that you're making, a physical thing, there's a cost to that sale. And then there's operating expenses in terms of staff members and renting hire cars and aeroplanes and stuff like that. And those things are separate items. So you need to understand which things are linked to what, Because if you look at now what we've discovered with COVID, a lot of people who never understood their budget properly didn't realize, well, if our business closes the doors, we can't do sales. Yes, we don't have any cost of sales. We don't have to stress. Yes, but you still have to stress because there's still salaries, there's still rent. So what are those things that you still have to pay even if you make no sales? It's important to understand those things and have then funding to cover those expenses, either while you're ramping up, expanding your operation, or like in COVID, we had to close our doors, and can we still afford to pay our rent? So that's important. Understand what these things are. That's what the budget comes into play. Okay, so the detail can be as whatever you need to have a clear picture of that. And then one of the other things is also we've seen with entrepreneurs is like, how much should I pay and myself? And this is a tough one because often the entrepreneur gets paid last. So what we've seen is that if you were employed by somebody to do the job you're doing of running a business, what would you be earning to do the job you're doing? Put that inside your budget. Even though your business can't afford to pay you that full amount now, you need to know how much sales you got to increase by, or how much costs you got to cut on your cost of sales in order to one day achieve that amount to pay you your full worth. If you're never going to achieve the target to pay yourself the full worth, get a job. Because it's really not worth the anguish of running a business and knowing you're never ever going to get to your full worth. Rather go get a job and then you don't have all the headache, because business ownership is not as profitable as people think it is. And it's precisely for this very reason that very often the entrepreneurs don't put the budgets in place. They don't track all the detail. They don't put what they should be earning in the market, which means they underprice themselves, and then they're going to cut corners. That leads obviously to other issues when our clients don't like you because you've got bad service. If you did your budgets right, you're going to avoid all that headache. Okay. Anything on this at the moment? Guys, any questions around that space?
No, it was clear. Thanks.
Cool. So if you guys haven't done your budgets, I suggest right after this you start and make sure you know where you guys are. Awesome. So,
Tyron?
Yes, sir.
I just want to quickly ask you, I think this is important for a lot of people out there, especially if you're not making money as yet or about to make money. I've asked you this before, and maybe I can ask again just for the group's sake. If I have an idea, at what point should I be worried about all these things? Because like with the other modules that we've covered, what we focused on a lot was getting validation from your market, because you can have all these beautiful things in place, but if no one's going to buy what you sell, then you're going to be wasting a lot of time. At what point and why then should one start investing in everything that you've taught us up to this point?
So what you'll generally do, how the pattern should work, is that you should do your budget. You have an idea. I've got a business, I've got this idea to this thing. Go and do your budget first. And your budget incorporates the elements we've covered in terms of the SWOT and understanding market access and stuff like that. And go and look, because generally very few people come up with an original idea. You know, it's actually quite groundbreaking when you see, like, Facebook wasn't an original idea. There wasn't anything like that available. And then people think of SpaceX and go, no, that's not an original idea. Rockets were going into space for decades. They've improved on an idea. And that's what generally happens. Most businesses that start on an improvement of an idea. I'm going to, like, think of pizza parlors. They all sell pizza. How many different pizza places are there? You know, look at a Chisenyama. They all sell the same thing, but how many of them are there? Lots. And how do you differentiate yourself from the next one? You iterate. It's either better quality meat, better service if you're selling pizza, better toppings, better this. And that's where the iteration comes on. So to come up with a fundamentally unique idea that the world hasn't seen, like an iPhone, that's hell of a rare. So don't think, I'm going to invest all this time for this unique idea. Problem is, if you're going for a unique idea, you've got the time to do that kind of stuff generally. So for most of us, we're actually iterating on an existing idea. So what you can do is go to the pizza place, go to the cheese and yama, go to the place, look at it. What are they charging the customer? What would you do better? I'd have better service. My staff will be better dressed. I'd have more parking. And that's how now you can really start using those budgets now and go, well, if I'm doing this, I'm going to need so much expense. I need an office. And you can start building it from there. And very, very quickly, over a space of even a couple of days, you can pretty much have a almost near complete business plan, or like a budget. And the thing is, the market wants it because these products are in the market. People are going to the pizza places and the chicken place, and you know what I'm saying. So they're going to the counter to get their books done. So these are known things. So the information is available. So once you've now decided, you've done your budget, and you want to go ahead now, you've either got the money, or it doesn't require much investment, or you can go then start shopping, family, friends, fools to give you seed capital. Then you can move into banks for overdrafts and stuff like that. And you go forward from there. I don't know if that helps you. Does that make more sense?
That makes sense. And I think what I've kind of asked it with the answer in mind is that I think even if you're in that idea phase, you still have a budget, you still have to eat, you're still going to have expenses, and you have to kind of, even if it's on a small scale, even if it's a side hustle, if you cognizant of what you're spending, what things are costing, and you get that discipline into your business, it's extremely important. And I think it goes for any new initiative within an organization as well, that one should always be just aware of what time you spend, what it costs, and at what point in time you think you're going to start, just to say, or to have your finger on the pulse and continuously know that this is still worth it, that the time that I'm plowing in is actually still being done for good use.
Exactly. And that's exactly what you want to do, because remember, when you go to that person for funding, you're going to be able to show them what you've spent already. And a lot of times, a lot of entrepreneurs, when they're starting up, they're not recording what it's costing them to get the business up and going. But we'll cover that just now. So give you an idea then. So when you look at the budget, that's going to potentially be your future income statement, because that's what you're aiming towards. So when you now start trading, you're going to be looking towards, as you start recording that income and you start recording those costs, you're going to see how far away from your budget you were. And then you can start fine tuning into the future. Oh, I'm well ahead of my budget. I've got way more sales than I thought. The costs are lower because I'm buying in bulk now. And now you can start fine-tuning your actual budget going forward. So your budget is your lead indicator. It's like the research for the trip, the holiday. The holiday is the experience, the actual income statement. But the budget is the research. What's going to cost? And then you get there and you're having a good time. So you drink far too much beer, so you're going to stay in a smaller hotel. So that's the kind of thing you want to be thinking around. Okay, so give you an idea. It can be very simple. Look at this. I mean, this is a very simple one. Staff salaries, director salaries, and these are the expenses we're looking to incur. And so before we even start earning an income, we've got to find 33,000 Rand a month. We haven't started work yet. You see, so it gives you an idea of where this is. You can make it complex by line items. You can go into full-on detail, and this will be determined by your business. So don't feel, let me make it complicated or let me make it complex, because maybe people will think it's a much more technical company. No, you want to be simple enough, but it must give you all the information required to run your company. So that is the key. Just keep it as that you can A, track all your income expenses and know where you're going, and B, when you show it to somebody else for funding, they can see immediately where everything fits. So, basic record keeping. One thing I've learned in my lifestyle of entrepreneurship is that every single entrepreneur knows these three things. Who owes me money? To whom do I owe money? And how much is in the bank? That's your books of account. That's how you run your books. People don't seem to think of those three things. You walk around that generally in your head permanently. You know you've invoiced somebody, so you know they owe you money. You know exactly how much it is. You know who's invoiced me and whose phone call you're not answering because you owe them the money. We all know this. We like, I owe this person money. And then how much is in the bank? Is there enough in the bank to pay the people I owe the money? Then it's not a train smash. No, there's not. Why? Because the people who owe me money aren't paying me. This is your books of account. Who owes me money is your income, your invoices. And once it comes in, there's money in the bank, and the invoices that aren't paid sit on your balance sheet as your debtors. The debtors still owe you money. Who do I owe money to? You receive, you incur expenses, you pay them from the money in the bank. If you can't pay them, they sit on your balance sheet as your creditors. The money in the bank is your cash flow. How quickly you can convert the money from the people who owe you into your bank and how long you can hold on to it before you pay the people who you owe, the better. That's the trick. So that's the basic. You walk around, I can guarantee you, every single one of us on this call have those three things on us immediately. I can almost ask you and you give me an answer immediately. That's your books of account. That's how simple accounting is, those three things. Okay, so we'll go into a bit more detail. Generally, you'll find like banks will ask you for things like management accounts, or somebody wants to see management accounts. Management accounts are just a really technical word for your income statement. So your income statement is very simple. It's your sales, less your cost of sales, which is then, as we say, part of your budgets that you're working on, less your overheads, giving you your net profit. So that's what your income statement looks like. Very, very simple. Sales, less cost of sales, less overheads equals the net profit. Your balance sheet on the other side is now the balance, and why it's called balance sheet. It's the balance of what's either owing to you or what you owe other people. The balance. The balance of the money that wasn't paid on my invoice is sitting on my balance sheet. The balance of the money I haven't paid to anybody because I don't have the money is sitting on my balance sheet. Those two things equal your management accounts. So when someone says to you, I need management accounts, it's your income statement and your balance sheet. That's what you're looking at there. So I was going to touch on some of the things that people often forget to include on their income statement. Often it's interest income. If you're fortunate enough to have a business that generates enough revenue, you'll earn interest, and that must be recorded. And then obviously the actual discounts that you receive from your and suppliers must be recorded on your income statement. Many times for smaller firms, they don't actually do that. So the expense would just be the actual amount you paid on your invoice, and the discount received is not tracked onto your income statement. Expenses, and this is crucial. Your money, the stuff you pay for out of your pocket, not money that the business earns. You start your business, maybe it's a side hustle at the moment, the petrol you pay for, the laptop you bought, the desk you're sitting at, even if you borrowed it from your sister and you then give her $100 later, all of those things, keep a record of them because that is tax-free money. When your business starts making money, you can take it back from the company tax-free because previously you earned it by having a job, so you've paid pay-as-you-earn on it, you've paid your tax, now it's tax-free. So many entrepreneurs don't record what they themselves invested to start the business. Very, very crucial. Another thing that we see often is entrepreneurs don't give the accountant the invoices they haven't paid. So they sit on the invoices like, no, I don't, because I still owe, I owe Jean-Pierre money, so I'm keeping the invoice until I pay for it, and then I can give it to the accountant. You're not going to have accurate books. We need to record it. So once we record the expense, Jean-Pierre Consulting, it's in your expenses, hasn't been paid, so it sits on your balance sheet as money owing to Jean-Pierre. Now you've got a proper record of what your expenses are, so you can claim properly. Home office expense. This has really hit big time. Very few people really got the concept of home office, or even if they had a home office, weren't really claiming it. Now with the whole world working from home, and this is the big shift that's taken place, you can claim expenses for working at home. So record those. Generally, you look at things like the interest on your bond, water and light, rates and taxes. You've got a housekeeper, the expense of a housekeeper, security, insurance. Those elements you can claim. If you're renting, it'll be a portion of your rental, electricity, security, insurance, things like that. So you don't have to be a home owner to claim home office expense. And obviously fines and penalties. Very important. People often don't put it on the books. You can't claim fines and penalties for income tax, unfortunately. You got to write it back. So, I mean, if you had a 10,000 Rand fine and a 90,000 Rand profit at the end of the year, you got to add the 10,000 back. So you pay tax on the 100,000, not on the 90,000 Rand profit. Why it's important to claim it or put it on your books is that you can now see, that you're incurring this non-claimable expense. And this is very true for me, and I saw it myself. Why make sure this is on there? Many, many years ago, I helped with a very large deal, corporate buyout deal, and one of the founders of the company, as a thank you, because I saved him a lot of money, bought me a sports car. And I was like, wow, thank you. And I raced around to all my meetings in my sports car, and I was racking up about 7,000 Rand a month in traffic fines. Because what's the point of a sports car if you can't go fast? And when I saw it on my income statement, I was like horrified. I used to then drive my car to my office. I took the money and I bought myself a little vehicle, a small little Opel Corsa van, the 1.7D, and I drove that around to clients. My savings and traffic fines paid for a vehicle. I would never have done that if it wasn't recorded on my income statement. So if you have drivers in your vehicle, in your companies, record it on there so you can see it happening. You can then claim the money back from your drivers. You can claim the money back from your other staff members or your business partners. You're costing the company money. So the money goes out the door, but you can never get a benefit from it in terms of a tax saving or stuff like that. So these are the type of things to just think about when you're setting up your books and what you actually and recording. Okay, so cash flow. This is what you're going to be looking. Cash flow is the life and death of your business. Okay. So when you're tracking your cash flow, try to keep your cash flow up to date. So do it as often as you can. So when you're struggling with, you don't have enough cash you're worrying about how you're going to pay your bills, do your cash flow weekly. So do it more often. You're struggling with cash, do your cash flow weekly, check on it. You can chase down your debtors, where's it going, maybe push your suppliers out a bit. Keep looking at this. It's an important thing to do. Highlight the non-negotiable days where you have to make payment, whether you like it or not. Things like a loan covenant, payroll, as you see, VAT. Certain things so they're in your cash flow so you can start managing these actual processes. Some of them you can control a lot more. You can make suppliers only due on the 15th of every month. So you can say, if you bring me all your invoices by the end of the month, like now, end of August, if I don't have your invoice by the end of August, you won't get paid on the 15th of September. And that's how you can sort of start to actually control your cash flow. because a lot of your clients might pay at the beginning of the month. Now you've got money, you've paid your pay as you earn. Boom! Now you can pay all your suppliers or a portion of them. So understand where the cash flow cycle happens in your company, and you're going to figure out very, very fast if your budgets are right, if your costing's right, because if you're always struggling for cash flow, it can mean several things, but generally what often happens is the company's in a growth phase, so all your profits are being reinvested into buying more stock because you've got more people who want it, and they might be paying not cash like at a spaza shop where it's cash immediately, so you can go run off to Macro, buy the next stuff, and you don't have a cash flow problem. But now when the people are paying you 30 days, but now you're going to run off to Macro to buy chips, and you're going to pay for it in cash, you don't have the money. So these are the type of things. So understand where your business. So if you're growing and people are paying you immediately, you won't have a cash flow. If the payment terms are pushed out, how do you compensate? You get an account at Macro where you pay 45 days now to Macro. Your clients pay you 30 days, and then at least you've got time. You can pay Macro in time, those type of things. So look at how you manage your cash flow, and it's sitting in your books. If you've got your budget and you've drawn that up, you'll pick it up very, very fast, and you can then start amending your terms. Certain people pay COD, other people pay 7 days from invoice. All your suppliers are 30 days, that type of thing. So it's all inside the numbers. If you're not keeping accurate numbers, you're never going to understand your cash flow of your company. Something someone wise once told me when I started out, it's called bookkeeping, it's called books, because it tells a story. And the story is about your business. And it's the ups and downs, the cash flow squeezes, the growth, the shrinkage. All of that is recorded in those numbers. Cool. So before we dig into tax, because this is a big issue for a lot of people, is tax. Any questions on what we've covered so far?
All good, thank you from my side.
Guys, anyone have any questions?
No, thanks. It was clear.
Yes.
Insight.
Okay, you got a question? Fire away. Okay, cool. Okay, tax. As I said earlier, you only pay tax if you make a profit. If you don't make a profit, there's no tax because it's income tax. All right, so view that. So don't worry, like if you're not making a profit, you're not going to pay tax. You do still have to put in your tax return though, but there won't be a tax bill that you have to pay over. Okay. And then what we said earlier is that what expenses can I claim to minimize your tax? Any expense in the production of income. Excuse me, and that's in the tax law, that's the line. Any expense in the production of income. And we've helped a number of clients. It is obviously personal. It varies from client to client, by sector to sector. There'll be elements like, for example, similar things like in some industries you can't claim the expense, but in others you can. So it'll be based on your company. But if you're unsure, the law is any expense in the production of income. So if you can draw a line between that expense and you earning money, claim it. That's as simple as that. If you're hesitant, does this help me earn an income? Yes, claim it. Okay, so if you walk away with only that after this, you're already ahead of a lot of people we've met in our lives. Okay, cool. Small business corporation. What's important about a small business corporation is that there's tax breaks for small business corporations. Problem we've found in dealing with small and medium enterprises is that all accountants are trained to work for big companies. So when they get to the sections on small business, the lecturer tells them, no, read these in your own time, blah, blah, blah. But they're training accountants to work for big companies and do books for big companies. So very often when we meet new clients, we find that the books have been done and the taxes have been paid over as if you're a big company. The accountant is either completely oblivious about the small business rules, and therefore clients end up overpaying tax. And it's massive. It's not just income tax, as you're going to see now. So small business corporation, guys, look at this. Understand it, because this is going to save you at least 100,000 Rand a year, minimum, if you qualify. So very, very important to understand it. Okay. You need to answer yes to all of these things. Your business gross income. So that's your invoices. When you're invoicing clients, it must be less than 20 million a year. Okay. So if you're turning over 20 million or less a year, tick one already. I'm on my way to being a small business. You can't be a personal services provider. Now what that means is, like, I'm an accountant, I'm providing a personal service. I'm doing your books. Okay? So generally, I'm a lawyer. I'm an estate agent where I personally do the service. You don't qualify as a small business corporation. However, there's a caveat. That's why the little asterisk on there. If I employ 3 or more people not linked to me by family, I then qualify as a small business corporation. Okay, so the law firm, the lawyer who's doing the work, if he employs 2 clerks and a secretary, boom, he's now a small business corporation, as long as his business is turning over 20 million or less a year. The shareholders, you and all the other people who own the company, are real people. You're not a business. So all the shareholders in your business must be actual people. It can't be another entity. Okay. However, you may not own another company. So you can't think, I'm doing 40 million or 35 million, I don't qualify. Let me split these in 2. One's got, half the income, the other one's got the other half of the income. Hey, I'm done. No. You can only own one enterprise. Again, there's always exceptions. You might own a company that just owns a property, and for example, like you said, on a body corporate, so you own that, or you own a company that you're winding down, it's got assets less than 5,000 Rand on the books. Those type of things that SARS just ignores. But effectively, you can't own another business of any substance. Okay, so turnover less than 20. I'm not a personal services, but if I am, I've got 3 people working there that are not family. I don't own more than one enterprise except the one that I own now. Now I'm already on my way. Not more than 20% of your income comes from professional services. So again, this is to deal with the personal services people. So where you're doing a professional service, and a professional service normally means that you belong to a professional body, tax body, accounting body, a legal bar, those type of things, professional services. So not more than 20% of your income comes from those type of things. Then you're good. And lastly, it must be a real business. Private company, co-op, closed corporation, a real business. Can't be a personal service. It can't be a sole prop. If you answer all of these things, you now enter the world of being a small business corporation. Okay. What are the benefits? These are the real benefits. The tax is the small part. And a lot of people think, oh, you save tax. But this is where you save the tax. You write off assets you bought for trade in the year of purchase. So I bought a brand new laptop. It cost me 50 grand. I write it off in the year I bought it. 100% write off. What that means, obviously, it depreciates by 100%. So my profits will drop by 50 grand. So it's important to understand that. Okay. So all your sort of trade assets, things that you buy, computers, tills, things like that, you write off 100%, small tools, all of that type of stuff. Instead of what the normal write-down rules for and depreciation would be like either over 3 years or 5 years or stuff like that. And then your manufacturing assets, you write down over 3 years, 50%, 30%, to 20%. And this is important. So you think, but I'm writing it down. Guys, depreciation, although it's an expense on your income statement, is not real money. You don't pay for in depreciation. It's not like you put the money out of your bank, you pay somebody in depreciation. What depreciation does is it lowers your tax rate. So the faster you write off elements, the less tax you pay in that year. Classic example of this, we had a client who was manufacturing juice and they needed a new truck and the banks wouldn't finance the truck. They said, it's crazy, they're not showing enough revenue to buy the truck. And the bank wasn't happy to fund these guys. So what we did was, we looked at the books. We looked at all the elements. They were a small business corporation. They met all the actual criteria. The previous accountant had not treated them for tax in terms of small business corporation. They never wrote off all these assets. So we went back and we wrote off the existing assembly line that they bought for R1 million. We wrote it off the previous year, 500,000 Rand towards them and depreciation. Gone. We then wrote off the truck that they had, the existing truck that they had, was about 400,000. We wrote off 50%, 200,000. Computers in their offices, all that type of stuff. Effectively, what we ended up doing was their tax bill was reduced, that they ended up having, they could buy the truck cash. So instead of paying SARS, the 900,000 Rand that they would have paid SARS and income tax, they could take that cash and they could buy the truck cash. And guess what the magic is? The next year, we write off half of it for tax again. So this is where the real value of being a small business corporation comes in. Is because depreciation is not real money. It's not a real expense. You don't pay for it, but it saves you income tax. And then lastly, of course, is the income tax itself. And that tops out at about 95,000 Rand a year. There's a sliding scale, so you can start seeing where it fits in. This is from the previous year's table, so it's not the existing table, but it illustrates exactly what we're talking about here. If your profit is less than 75,000 a year, you pay no income tax, none. For a lot of small businesses, they'll be lucky if they're making 75,000 Rand profit. So there's no income tax. If you're not a small business corporation and you make 75,000, you're paying 21,000 Rand in income tax. Okay. As you can see from the sliding scale, 75 to 365, you would have paid 102,000. So now you pay 20,000 plus 7%. So your tax saving is 81. From 365 to 550,000, your tax saving is now, 94,000 Rand. So give you an idea. I mean, if you can see the saving, and you think, but 95,000 Rand, what does it really get me if I save 95,000 Rand? I think the cheapest car in the market at the moment is a Datsun Go. A Datsun Go costs about 95,000 Rand, 90,000, round about there. So from the taxes you save by being a small business corporation, you can buy a brand new Datsun Go every year, which you can put onto a Bolt driver or something like that. But the next year you write off 50% of that. So next year, the 95,000 Rand, I write off 50,000 Rand for tax and depreciation on the profits I'm going to make from using that vehicle. So you've got to look at this in the whole process. So look at your business, look at how you set up your business, make sure you understand the budgets. If you're keeping track of your expenses and your income in terms of your bookkeeping, these conversations about saving money are huge. And there's not even any funny tricks. It's not like, yeah, but I'll hide the cash and I'll do this. I'll pay my brother and he gives it back to me. Guys, these are legitimate tax savings from the government. It means are proper things that you can use to grow your company and take it forward from there. So look at your business. If you want to chat to a tax person, do that. Understand where your savings are, what you've been overpaying. I can guarantee a lot of people on this call, this is the first time they're hearing about small business corporation. So yeah, definitely have a look at that. So yeah, before I dig into the details of what you must be looking at, any questions around tax, small business corporation tax, just tax in general? Anyone?
Yes, hello. Can you?
I stunned everyone into silence.
Hello, it's Andile.
Yes, Andile.
Yes. Is it possible for one to actually submit all the tax returns without using the services of an accountant?
Absolutely. Absolutely. You can, by all means, submit your own returns. SARS does have training programs for the sort of for entrepreneurs to go into a SARS branch, how to use e-filing, how to use, submit the EMP 201s or the VAT forms. So all of that is available. They also on their website have got user guides. So you can most certainly go and sort of figure it out and then do it. A lot of people obviously just employ an accountant to do so because generally the law has become so complex and there's so many little nuances that you're going to miss it unless you're actually involved in the game. I mean, even chartered accountants that we've dealt with over the years and trained didn't know what small business tax was. It's actually frightening to see how these guys don't have a clue, but they've been accountants for 15 years, never heard of it. So yes, you can do it, but it's going to be your time. And while it's you got time, by all means, go understand it, save your costs, and then as your business grows, then definitely look towards an accountant to help you.
Okay, thank you very much.
Cool. Anyone else? Nothing. Cool. Okay, guys, then I'm going to just dig into what you should be looking for. So when we're assisting you guys with your books on this program, you're going to see a dashboard. We're going to register you on a product called SME Snapshot. And these are the things we're looking at. This is what you need to be running your business on. And we're sort of looking here. Here's all your regulatory stuff we were speaking about earlier, your financial year end, your SIPC annual return, VAT returns. These things will remind you when these things are due, so you know when your regulatories are done. Profit margins, gross profit margins. So if your budgets are right, you'll be able to see, what is happening inside your company, where it's going. Track your cash flow. Track your sales cycle. You know how few entrepreneurs understand their sales cycle, when they make their money, when they actually don't. And these things are quite important because if these are quiet times for you, what can you bring in that's complementary to your existing product so that now while showers and stuff don't sell during winter, we might sell heaters, so you get another sales item. So anything that's complementary, and that helps you then view these type of things from there. So this is crucial for you to understand exactly what we've been talking about. Cash flow. What does my cash flow look like? Am I losing money? Burn rate. This is a very good one that we often utilize. So it's effectively if you made no more sales, not one, how many days before you run out of money And this sort of indicates the health of your company. So this will give you an idea. In this example, it's going to be 8 days before they run out of money. So COVID highlighted that for a lot of people. I got no more sales. How long before I run out of cash? Actual money. Net profit margins. You want to see what your margins are in terms of your profit. Net profits obviously meaning you're making money, you're growing, and going from there. Your sales cycle, as I pointed out earlier, it's very important to see turnover, cost of sales, gross profit, what your margins are doing. Okay. Before I go in to discuss further like funding elements, any good questions on these ratios and information in order to understand your book? Anyone? Okay, cool.
Sorry, I don't.
Pardon?
Yes, I'm saying I don't understand what each line graph represents in terms of these colors.
So this one that's on the screen now, I mean, these will represent your turnover, your cost of sale. So effectively, if I just did a larger picture of this element here.
Oh.
And if you look here, blue's turnover, orange's cost of sale. So it'll be indicator of that. So once Duhmasani and Ken have sort of finished all your applications and we move you guys over to do your books, you'll get this screen where you can actually drill in and see these things. So even if you're not making any money in terms of turnover, your expenses will be there. And that will then lead into what we're talking about in terms of budget. You know, are you accounting for all the right expenses and things like that? So that's literally what these things are just showing. Okay. Cool.
Thank you.
Funding is a big thing for SMEs. We all need money to get started. Generally, the easiest type of funding is friends, families, and fools. So your friends will help you. They believe in your idea. They put some money in. Your family believes in your idea. They all believe in you. They loan you some cash to get going. Or fools, we say, but those are people that, without a tried and tested thing, will happily loan you money. I mean, it's just they're not really fools. So don't take it that way. It's like literally fools. So that's the normal start, how most SMEs get going. Friends or family, or they got a job and they've saved up and they've gone from there. So when you've got an actual business, generally the easiest access to funding is an overdraft, because that generally flows through from your actual turnover going through your bank account. So as the bank sees the money going in and out of your bank, you get a credit score that will then determine, you know, that they'll feel comfortable lending you some form of cash. And that normally becomes an overdraft, and then it goes from there. If you've got assets to back up an actual loan, they'll then give you a loan in terms of the business. I mean, often you see it when you buy a Nando's franchise or any of those, like KFC, any of those type of brand names where they know it'll make money. They'll do a business loan, and if you've got a home or something, they use that as surety and they give you a loan. But for smaller firms, it works the same way. You might have an insurance policy or something, and then the bank will do a loan against that to help you. So that's normally the next sort of tier of lending that you get. Definitely harder than an overdraft. But something to look at is invoice discounting. There's a number of companies out there. You guys might have heard of companies like Yoko and Ikoka, and things like that, where you got a card machine, retail capital, merchant capital. A lot of these guys, they invoice discount. So you supply generally what we call a blue chip company. So you manufacture something, you supply a larger company that's got a good credit record, and the payment terms might be, so you manufacture sauces and you supply Spar, but the payment terms are 60 days from the day you drop it off. you won't now have to wait 60 days to get your money, but companies will then buy your invoice from you. So effectively, they'll give you 70 cents on the rand for the value of the invoice, charge you a small interest, and then when SPAR pays you the invoice, you then settle the loan you've taken from them. So they discount your invoice. Guys like Yoko and that, where they use a card machine, of course they see the money coming through your card machine, they can give you an overdraft effectively, but if they're discounting your sales, they'll give you a loan, and then every time a sale goes through on your card machine, they then take a portion of that amount back to settle the loan they gave you. So that's quite an easy way of getting funding to cash flow your company to start with. But this should be things you think about when you're setting up your business plan or doing your budget. Asset financing obviously is another thing we often need, is like a vehicle. So a lot of entrepreneurs, when they're leaving their job to start their business, will use the safety and security of a regular income to extend their credit card facility, finance that vehicle in their own name, get an overdraft in their, because the bank thinks they still get a salary. Then they resign and put all that money into their business and work like hell to make it work. So those are the kind of sort of typical bank financing that you'll see when you want to, when you have your business. Other types of stuff is unsecured lending. So there's a number of these guys out there where they'll bridgement. Again, it's based on your turnover. It's based on your cash flow often, and then you can actually they'll give you a loan based on that. So it's unsecured, meaning you don't have to put up surety or anything like that. It's running out of your cash flow. Convertible notes. So if you want a funder, you want to get to somebody who wants to fund you. Generally, what someone will do is they'll give you a loan, and the other side of that, if you can't pay the loan, it converts into equity, shares in your company, which then allows them to come and fix your business and go from there, grow it from there. Other types of funding you'll get is when you sell equity. So you sell shares in your company to people. So you now have actual cash to get your company going. And then one of the often ones that people overlook is your suppliers. So now, for example, to give you a good idea of suppliers funding your company, if I'm a builder and I'm going to go do bathroom maintenance as an example, I could maybe go get a account at Builders. It's 30 days. I go to Builders, get my account, I get my client, quote my client, 50% down payment before I start the job. And then I go to Builders, I buy all the stuff, but I buy it on my 30-day account. And then I go and I do the job. I'm done in a few days. I get paid. I still owe Builders the money, but now what happens is I got another job. Now I can buy those new things cash. So now I can go into another Builders, not where I have my account, and go, what if I pay cash? And normally you get a 5% discount for cash or things like that. Again, a few days later, you've completed the job, you've been paid, and by the time your suppliers, your sort of builder invoice comes due, you've turned that initial supply from them around 3 or 4 times in that month. So you can very easily settle your invoice to builders. So that's a very simple example in terms of suppliers funding your business. There might be, if you want to do sales, there might be people who will give you stock on, consignment. So now you can go knocking on doors, buy these items, this perfume, and only when you make a sale, you go and you pay the supplier their fee. So those ways the actual suppliers then fund your actual business. Very important to look at these different types of funding mechanisms. Cool. Questions? Anything, guys?
Sorry, Tyrone, I'm not sure if I might have missed it, but I think what's a valuable piece of information or wisdom I think someone shared with me is that one should always try to facilitate a sale long before you do any form of lending or go into debt in any way of sort or means. So I'm not sure if you've said that.
Yeah, no, well, that's effectively, you preferably want to run your company without having any debt whatsoever. And a lot of people look at debt and they go, oh, it's debt, it's bad. We don't view it that way, because a lot of entrepreneurs generally don't have money to start with. They need to incur some form of debt, and that debt would be owing a supplier or things like that. So providing you utilizing the debt to grow revenue, you don't get an overdraft and take all your friends on a holiday, because once you've pissed that against the wall, you got to pay it back. So when you take on debt, if the interest rate is 10%, the job you're doing, the margin must be way higher than the interest rate. So example of the bathroom is the builder. I take a 50,000 rand like sort of credit at Builder's Warehouse, and I know at the end of the month when I pay them, I'm going to pay them 55,000 rand. So it's 10% on the invoice. I mean, that's a very simple example. But when I go and do the job for the client, my profit that I make after paying all my expenses, including build, it must be higher than the cost. So generally you want to be much higher. If I'm paying 10% interest on my debt, I must be earning about 25% margin on the other side. So that the trick is you then work yourself out of it. So debt is a very good thing if you know how to utilize it. So yeah, ideally you want to be in a cash positive situation, but don't be afraid of debt unless you're going to use it to buy beers at the bar, and then it's going to be wasting. But beers in the bar might be good if your clients are in the bar and they then obviously give you extra work. So just weigh it up in terms of that.
So what's the moral of the story? Always make sure your clients are also in the bar.
Okay, so something I learned about compound interest, and that's what happens with debt. Okay, because the interest compounds. So someone told me compound interest, if you understand it, you earn it. If you don't, you pay it. So effectively, if you don't understanding the debt mechanism and you're taking loans to go on holiday, it's costing you a lot more money. If you understand the concept of debt and you're able to on-sell the product or service for much higher than what it costs you to get the funding, you're earning interest, you're earning money. So, and that you'll know from your business, from your actual budget. So that should give you guys, I mean, I know this is a hell of a lot of information to absorb in such a short space of time, but look at these things when you're setting up your business, setting up your budgets. Cool. Any other cool questions? Anyone else? Fabulous. Okay, guys, thanks a lot, man. Thanks for your time. Hopefully that was of value. Yeah, and we look forward to the next session.
Okay. Yeah, thank you very much for insightful presentation.
No. Excellent. Okay, guys, thanks a lot. I'm sure Masani and Ken will be in touch with you guys again in the course of this week. Yeah, let's just actually go from there. Thank you. Enjoy the rest of your day.
Thank you for the session.
Thanks.
Cool.
Andrew Masani.
Hey, Jan. How's it going?
No, good. How are you?
I'm all good, man.
Oh
Just
yeah,
want to quickly
Yeah.
I just want to quickly invite the rest of the crowd back into the thingy so we can just quickly chat.